Thank you, Mr. Chairman. Thank you all so much for being here. Appreciate your time and your input on this very important issue. And just to discuss Dodd-Frank and absolutely necessary regulatory relief for community banks and credit unions. I've come to strongly believe that Dodd-Frank is damaging our economy and is slowing our nation's economic recovery. Dodd-Frank's current regulations and guidelines span 8,231 pages, and I think that's just 60% about of what's coming. Our nation's job creators will spend around 60 million labor hours and employ 30,000 workers to navigate this bureaucratic minefield. Unfortunately, community banks and credit unions, which help people access the American dream, have been disproportionately hurt by Dodd-Frank. These institutions provide almost half of small business loans and serve 1,200 rural counties that otherwise would have limited options. Without them, as we've heard today, many responsible Americans would not own a home, start a business, or be able to preserve a family farm. Community financial institutions depend on personal relationships and local knowledge of their community to lend. This means they can tailor-make loans to fit their customers' needs. This lending model absolutely works. These lenders know your story, know your business, and know exactly what kind of loan you need. Large banks often can't follow that lending model. Their size forces them to make simple, plain vanilla loans and disproportionately consult statistics like income or credit score to evaluate borrowers. Our economy absolutely needs both kinds of lending. Unfortunately, parts of Dodd-Frank target the relationship lending model by forcing these smaller institutions into regulatory straitjackets tailor-made for big banks. For example, in my home state of Illinois, Robert Smith of Soy Capital Bank and Trust Company has told us that the qualified mortgage rule has reduced their ability to make mortgage exceptions to people with unique circumstances, even though they can afford the loan. Real lives are disrupted along the way as banks reduce lending, merge with competitors, or shut down. Thankfully, there are bipartisan solutions to provide much-needed relief to community banks and credit unions. My constituents in the 14th Congressional District of Illinois are desperate for real solutions here, so I'm grateful for the opportunity to explore them with each of you today. My first question I'm going to address to Mr. Williams, then wondered if Mr. Fenderson, Mr. Miller, and Ms. Bosma-Lamascus could also comment. Proponents of regulatory relief can be painted as against consumer protection and eager to return policies that caused the financial crisis. I find this narrative ridiculous, including when it comes to regulatory relief for community financial institutions. Consumers need regulatory protection. We all agree with that. But these institutions were not the cause of the financial crisis, such as subprime lending, securitization, or derivatives. Would targeted regulatory reliefs for small banks and credit unions return us to policies that caused the financial crisis, do you think? I'll start with Mr. Williams.
It would not. It's a difficult question to answer, Congressman, but we need the relief so we can provide the services to our customers. I agree with everything you said. We know our customers, and we're going to try to find ways to make the loans. What has happened is examples in Dodd-Frank under QM have made it difficult for us to approve those credits.
The flexibility to do our jobs and to serve the customers that we serve is all we're asking for, and that obviously comes in the form of relief because of the unintended consequences that we deal with. Let me be clear. Small institutions, as everyone knows, is not regulated by the CFPB. However, the rules that they regulate create a playing field that we have to participate in.
Yeah. Let me get on to my next question. Probably you all would echo similar things there. And this is personal for me. My family owns a funeral home. I grew up in a family funeral home, and I'm convinced that my mom and dad would not have been able to purchase that funeral home in the mid-'70s but for a local community banker who saw something special in them. The idea of judgment, being able to know a person, know a community, and be able to make a decision. Dodd-Frank takes that away, takes that ability away to be able to know a customer, have a business model, know a community, and be able to make those decisions. To me, that's tragic. And I think it also is reflected in the fact of the lowest number of business startups that we've seen in 3 decades is part of this problem. Let me touch quickly on community financial institutions don't need same regulations as large ones. As the Fed Governor Daniel Tarullo has said, many rules and examinations that are important for institutions that are larger do not make sense in light of the nature of the risk to community banks. And a question would be, could we have some sort of tiered regulation? Should we give Federal Reserve or other regulatory agencies clear legislative authorization? I know we just have a few seconds, so if any of you have a thought.
Short answer is yes. because we didn't create the problem, and all of us combined as small community banks and credit unions don't add up to the larger bank, the systemic risk created by the large banks.
Absolutely, yes.
My time's expired. Thank you for being here. I know it takes courage sometimes to come out and talk about these things, but we need your voice. I yield back to the chairman. Thank you.